They're out of cash. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, U.S. property developers are facing a cash drought, and this is not unlike what happened with China's property developers as they ran out of money. And this time in the U.S., it's because banks are tightening lending standards, and we predicted this would happen because when banks curtail lending, there's less money being injected in the economy. It's only a matter of time before someone runs out, and now we're seeing it with property developers. And what I want you to see is how this paves the way for the next recession and the Fed cutting rates back to zero. Let's over to Reuters, where we picked today's story up with a headline: U.S. hotel developers run out of cash as construction lending dries up. And, this is an interesting headline because you think about, you're in the middle of building a hotel or some other project. You're running out of cash. What does this mean for the broad economy? Well, on the onset, what do you think it means for labor? Of course, you can't pay people if you don't have any money to finish the project. You think about equipment sales and durable goods. You see it all start to line up as we head now into a recession. Tighter lending standards from regional banks are making it harder for U.S. hotel developers to secure funding, slowing construction of new hotels at a time when America's appetite for travel is ripe. Now, we do know that travel demand this summer is looking pretty robust. The only question is, how much longer does all this pandemic stimulus stay in consumer bank accounts? We keep hearing from the government that everyone's sitting on piles of money. Many of you have weighed in the comments and said, no, I really don't see that to be true. But there are clearly people that do have money and they do want to travel, or at least they've already spent their money on travel and they're going to complete it. The question is, do we think demand for travel continues in the years to come as we head into recession? Well, probably not, but that doesn't stop developers from building. Hotel developers, private equity firms, and general contractors have noted financial stress on regional banks. What a shock. The largest lenders to hotels and other commercial real estate markets, which has forced developers to postpone projects or find other creative ways to raise capital. And we talked about how we knew this was coming because these regional banks, they do a lot of lending in the commercial space. You would think it comes out of the large commercial banks, but it doesn't. They actually do quite a bit less lending in this space. This is why the small and regional banking system is so critical for the development and growth of new projects in our economy. And it was only a matter of time as they faced a cash crunch from deposit flight that they'd be forced to curtail lending. And sure enough, now we're seeing it. And here you can see the net percentage of domestic banks tightening lending standards for commercial industrial loans. This from banks of all size. So we knew as this happens, it's only a matter of time when you see the blue line go over the horizontal black line. What it indicates as it's rising, that lending standards are tightening at a faster pace. And then as you see it drop, it means lending standards are still tightening, but just not as fast of a pace. So when you get to the levels where we're at now, it's consistent with a recession because the key part here is new money gets injected in the economy. When banks lend, when they curtail lending, less new money enters the economy. It becomes a game of musical chairs. There's only, at this point, there are not enough chairs for all the people who need money. The music stops as lending standards tighten and someone loses out. Now it's hotel developers. And we can see this occurs because the yield curve has predicted this. Now remember, banks borrow at the short end of the curve and lend at the long end of the curve. So when short-term interest rates are higher than long-term interest rates, well, their profit margin gets squeezed to a point where it's even negative. So they don't actually want to lend because they'll lose money. And here you can see the red line, the yield curve. Here as it heads into inversion and it starts to get close to it, what happens? Lending standards tighten. As it further inverts, lending standards get really tight. You can see it again around 2006 as lending standards started to tighten. What happened? The yield curve was inverted. You see that going into the pandemic. Now remember, we're facing a global recession here. The yield curve was predicting it. The pandemic happened instead. And now look, just as the yield curve approached inversion, what happened? Lending standards sharply tightened, and now they are very tight all across the board. But who is the catalyst of this? Who is driving the short-term interest rates up? And it's the Fed, because when you understand what the yield curve is telling you, now you have to remember remember now, the Fed does not control the long end of the curve. Many people believe out at the 10-year mark or 30-year mark, the Fed's got total control of it, and they don't. What the Fed is telling us, and we know this because we keep hearing from Fed Chair Powell and all the FOMC board members, what's the problem? The labor market is too hot. Inflation is too high. The economy is running too strongly, and we want to cool it off. And that's what they're trying to do at the Fed. They're trying to raise short-term rates to cool off the economy. But what's important to understand is if the economy was running red hot like they claim it is, if the labor market was so robust, if demand was so strong, if inflation was persistent, long-term rates would be higher than short-term rates. So when you see these inversions, what the yield curve is telling us, look, we don't understand what the Fed is up to because they're driving short-term rates up, but what we see in the future is growth slowing, inflation slowing, and labor demand slowing. We're seeing all sorts of indicators in the yield curve, and as we look at this next chart, what do we know? Of course, the federal funds rate, the reason we see the curve inversion is because the Fed gets this idea that they need to keep raising rates. And what do you see? An inversion trigger. You see higher rates near inversion, higher rates inversion, higher rates inversion, higher rates inversion. So it goes on over and over because what we can see here is the Fed is ignoring what the bond market is telling it right now. And it does it consistently in the past. It drives up short-term interest rates to the point where the curve inverts. Banks curtail lending, they tighten lending standards, less money is injected in the economy, and you get a recession if you're lucky. If you're not, you get an all-out financial crisis as defaults as delinquencies turn into defaults, and now what we're facing is a bunch of half-bill hotels. Since March, 59 of the 98 total U.S. hotel projects that broke ground or were in pre-construction phase this year have been paused, according to previously unreported data shared with Reuters. And what we're seeing here is, of course, now this talk about, you have these unbuilt buildings. You have run out of money. You're the builder. You have no more money. What are you going to do? You're going to send people home. And this is why I made the case of why when you see tighter lending standards, it's only a matter of time before you see an increase in initial unemployment claims, because it's simple. Fewer projects, fewer money, fewer labor. And here you can see in this chart, what do we know? As lending standards tighten, the 4-week moving average, which with a lag, and it would make sense with a lag because obviously if you're running projects, you've gotten loans, you've gotten money. As you run out of money or as you cannot do new projects because you can't access the credit markets, 4-week moving average of initial claims heads higher. You see it going into the global financial crisis. We don't quite see it during going into the pandemic, but we note that the 4-week moving average of claims flattened out and was starting to turn higher, and now we're seeing it again. And what do we keep hearing? No, the labor market's strong. We're not going to see a downturn here, but all the indicators say global recession is, if nothing else, a U.S. recession. We're going to see layoffs at a time when no one really believes they can happen. Analysts say slower hotel development will also limit profits of blue chip manufacturers like Caterpillar, whose commercial real estate customers account for around 75% of construction sales. Customers are scaling back on equipment purchases, which makes perfect sense. If you can't get the money to finish your building, you certainly don't need new equipment. This is, they're saying, deterred by higher interest rates to finance or lease machinery. The reality is it is more of a function of lack of new money to continue to run these projects. But something you shouldn't be limited on your profits is your trading profits. Now remember, if you missed out on this tech rally, and many of you said, look, if your report can show the reversal, and I'll show it when it triggers it, we'll show it live on this show. But notably, if you missed out on this tech rally, you shouldn't have. Our CTA-Timer Pro told you to start taking positions down here. If you missed it, it said on this pullback, take more positions. It's caught the rally up there. Here it is, January 9th report. Then we told you the machines were deeply short. Look for a reversal. What happened? They reversed, and notably, we saw a price go up. That was your first signal. Here was your second signal. If you missed that on March 15th on that pullback, we said, look, machines are starting to buy again. There was your other signal. It's only $30 a month. At some point, we're going to raise it to 40, so you got to get in and lock your price in. Link in the description below. Let's continue on because I want to show you, the notion that this is going to be bad news for companies like Caterpillar. Well, we validated that this week in the durable goods report. As core U.S. factory orders unexpectedly shrank in April, actually this was from last week, the weakest since COVID, this from Zero Hedge, it really should not have been a surprise given the weakness in the manufacturing PMIs, but headline and core U.S. factory orders disappointed in April. We said this would eventually happen as the headline factory orders rose just 0.4% month over month, half the 0.8% expected. And worse still, the March data was revised from 0.9%, which was pretty hot, down to 0.6 month over month. Here you can see on that month over month is just barely higher, but look at that year over year decline. It's come way down. I'm going to show you, we're going to look at these lending standards here in a couple of slides, and we could predict this was going to happen because again, it's all a function of the banks creating new money. As new money gets entered in the economy, it gets spent on things. You're going to build a building, you probably need equipment, you probably need labor, you probably need durable goods. You're going to see it all start to flow. It all has to do with the banks, and it has to do with the fact that the bond market does not buy into what the Fed thinks is happening. Here we can see in core factory orders, this is taking out transportation. It was even worse, dropping 0.2% month over month, the third straight monthly decline. So here we can see it's heading lower. This left the core factory orders down 2.2% year over year. So we're seeing a negative, the biggest drag since COVID lockdowns. The question is how long, they ask, can the manufacturing side of the economy continue to collapse before services? Well, we know, as we said in the other show the other day, services is coming down. But now let's take a look. Let's go back to those charts we had up before, and where we're looking at the tightening of lending standards across all banks of commercial industrial loans against manufacturers' new orders of durable goods. And again, what do you notate here? That as lending standards tighten, and again, this would make sense that there's a lag here because initially they're just getting tighter. There's still projects that are being funded, but at some point banks are saying, look, no more money. And what do you know? Of course, manufacturers' new orders on a year-over-year rate change go into decline. We see that going into the dot-com bubble. You see it into the global financial crisis. You see it around 2015, 2016 when we almost had a global recession. You see it before the pandemic when we almost had another one. And now you're seeing it again. And most of this has to do with the banks tightening lending standards. It's so critical that the whole economy, when you're in a debt-based economy, everything is about new money being created to pay off old debts and to fund economic expansion. The Fed doesn't get it at all. Small to mid-sized banks, including lenders with less than $250 billion in assets, hold roughly $2.3 trillion in commercial real estate loans for structures like offices, hotels, and warehouses, the equivalent to 80% of their total liabilities. So when we talk about further problems at the small and mid-sized regional banks, which I predict are going to see more failures, especially as we head into a recession, they got to refi these properties. They're going to lose value. You can see that they're holding a ton of this debt. Overexposed regional banks are now offloading, no surprise, commercial real estate loans at a discount. Got to get rid of them before they get worse. As troubled regional lender PacWest announced in May it would sell $2.6 billion worth of real estate construction loans. And this is why, of course, bond bulls bet the Fed is right in anticipating low rates to return. The key question here is, are bond bulls actually not bullish enough because they don't understand how low rates can go? And I know many of you say, Steve, rates aren't going back to zero. The Fed's not going to go there. Watch and see. The Fed will be back at zero faster than you can imagine when things start to unwind. Over the next couple of years, we think long-term rates should be lower, and this from one expert. If the Fed is serious about getting inflation down to 2%, it's going to take a recession to do it. Well, it'll just take a little bit of time, but a recession will certainly help, and recessions usually result in a flight to quality of buying treasuries. Not only does that, but the demand for lending falls too. So if no one's borrowing money because they can't, well, rates have to go down. It's also a function of how the monetary system works. But the yield curve is predicted this time and time again. Here you can see, let's go back to this chart with the federal funds rate against the 10-year, 2-year yield curve. The 10-year, 2-year shown in red. What do we see here? Inversions are followed by rates coming down. Of course, that means the Fed cutting rates. You see it happen going the dot-com bubble, the global financial crisis. But the key thing here to understand is the Fed's been to zero once. It went to zero again during the pandemic. And many people say, there's no way we're going going back to zero, you're right, because if they could go negative, that's where they would need to take the funds rate. That's how we know they're going to do more QE in the future. The funds rate's going to go back to zero for the third time. The Fed will probably be creative. They'll probably do monster amounts of QE. The only question is, what else will they do? What do you think? Is the Fed going back to zero at some point, or do you think that now rates can only go higher? Would love for you to weigh in the comments. But not all are convinced yields are heading lower. Jim Grant, the founder of Grant's Interest Rate Observer, says he sees a long cycle of rising interest rates ahead. Well, Grant, we disagree with you here, because what do we know? That every time the Fed cuts rate, and we're making the case, while they cut rates once to zero, twice to zero, 3 times they'll go to zero. But looking at the 10-year Treasury yield now overlaid against the federal funds rate, what do we know? What do we know? That after the global financial crisis, 10-year Treasury yields made a new all-time low. They made a new all-time low during the pandemic. Third time, my prediction is they're going to make another new all-time low, possibly be the 10-year being at zero or even slightly negative, if you can imagine that. But we're also seeing this in the oil market, validating that it's not just the U.S. economy is facing problems, it's the global economy. As Russian crude flows stay high, as OPEC Plus partners call for clarity, as I called out on Twitter last night, well, that rally didn't last long from the production cut. And sure enough, Bloomberg notes the oil races all gains that followed the Saudi-led production cut. It's really no surprise, as West Texas Intermediate traded near 71 a barrel on Tuesday, while Brent was above 75. The decline comes after Monday's short-lived surge, not even barely an overnight surge following the Saudi announcement over the weekend. For now, the main driver of crude oil prices continue to be concerns about global growth. This is exactly what the yield curve is telling us, and demand outlook. This is, again, what the curve is telling us, not only in China, the world's biggest importer, but also the U.S. and other key consuming reasons. And here's a good reason why. When you take a look at that 10-year, 2-year yield curve, now shown in blue, against crude oil prices, this is West Texas Intermediate in red. Now, what you can see is as the curve steepens and comes out of that inversion, it's not unusual you get a spike in crude. We've already seen that. And then what happens? Crude prices collapse as global economy slows, demand slows, credit slows. You see that here going into the dot-com bubble. The curve steepened, validating a recession was about to happen. Crude oil prices came down. You see going into the global financial crisis, crude oil prices surge, then come crashing way down, giving you a huge opportunity to short that. Here you can see the last curve inversion before the pandemic. Crude oil prices crashed, and now we're seeing as well at a time, of course, when no one thinks crude oil is coming down, but the curve, the banks, everyone's telling us that this cash crunch that U.S. property developers are facing is only going to get worse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.